Don Hanna. He's Managing Director at Fortress Investment Group and also spent 7 years with the World Bank as an economist covering Asia and Eastern Europe. Don, thank you very much indeed for joining us. First of all, they're not doing this, the Chinese I'm referring to, out of purely altruistic reasons.
No, of course not. They're doing it in part because they have a huge stake in financial stability globally, given that 3.18 trillion, as well as the exports and their growth. So they want Europe to survive because that will help them.
And indeed, many of the assets that could come on the table would be at remarkably good value, one would think.
Well, that's certainly the case in terms of direct foreign investment, and as opposed to the bond investment. I'm sure the Chinese, frankly, would prefer to have the direct foreign investment rather than to continue with financial investment, because ultimately their concern is that their economy and their currency will appreciate relative to the euro, and therefore their financial holdings will tend to not generate quite the returns that actual holdings of physical assets would give them.
So the route they're going to choose will probably be, I guess it could be both, and it will be both.
Of course it will be both. They're big enough that they will do both. There is part of what they would like to do, I believe, is to use their ability to provide financing in the short run to help with the difficulties that various European sovereigns have, with greater leverage to have access to foreign direct investment in European companies. Because that, as I said, I think is not just in Europe but around the world something that China would prefer going forward relative to financial investment.
Right. When it comes to actually being an investor, though, I mean, last year was horrible in terms of all the nerves, and this year started off as though we'd shrugged off those concerns, but we're back where we started, it seems.
We still have a world in which European growth is likely to underperform. What's happened with the ECB and its long-term repo operations is that's provided liquidity to the European banking system, making a seize up there less likely, but it doesn't mean that European balance sheets, European financial sector balance sheets are likely to expand. They're probably still going to contract, and growth is still going to fall. So that's problematic. But at the same time, there has been somewhat better numbers out of the U.S. That's helpful. And in Asia as well, the PMI numbers look better. So net relative to 6 weeks ago, we're probably better off. But a lot of that is already in market prices.
But it does seem, Don, that the EU speaks with one voice at some stage, and then, you know, we had that with Greece. Greece's parliament ratifies the austerity bill, and then, well, they're cold feet again here. I mean, is there just a lack of any political consensus in Europe and a lack of political insight or even wisdom?
Oh, I'm not sure that I wouldn't go so far as to say it's questions of wisdom. I think it's just questions of differing opinions about the ability of the program that's being put together to be successful. Remember, even under the assumptions that are in that program, with the additional debts that the public sector will provide and the near 70% haircut on the private sector external bonds, you're looking at debt in 2020 that'll be 120% of GDP. That's where Italy is today. That's a very high number, still very fragile. And on top of that, you've got the tensions associated with whether or not the Greek populace at large will accept the kind of adjustments that there are in that program. So many in Europe look at that and say, well, I'm not sure if I want to put more money in if the program isn't going to be successful. That's the tension that you're seeing in the statements from different finance ministries around Europe.
Don, thank you so much for your time. Thanks for stopping by. Don Hanna there from Fortress Investment.